The best investing strategy you should have during a recession. The time to invest is different for a recession and a recession prediction. When a downturn has already started, few choices remain. The most prudent measures can be taken in advance of a downturn. Given the unpredictability of economic cycles, the best course of action is to take steps to ensure your portfolio can withstand a variety of downturns. Here are some tactical tips, both good and bad. Hello everyone and welcome to another video on our channel. In today's video, we're going to discuss the best investing strategy you should have during a recession. So stay tuned to find out. Now let's start our video. Suggestion 1. Don't panic and sell. In most cases, sellers who panic are mistaken. If you have diversified your portfolio sufficiently, a recession or bear market need not be catastrophic for your portfolio's value. Your investment portfolio will recover. Who knows anyway? There is not much you can do if it turns out to be the world's end. It's acceptable to gorge on chocolate-dipped ice cream to your heart's content. Extreme fear can have negative effects on health. It would help you if you tried exercising, reading a book, or adopting a stoic attitude instead. What matters most is how you respond to adversity. The first rule of effective investment is to isolate oneself from external influences. Suggestion 2. Do nothing at all. Sit still. Stop looking at your portfolio. John Bogle mixes index stock and bond ETFs. Vanguard founder Jack Bogle favors VTI and VTB. Both have low spending ratios, 0.02% and 0.03%, and natural diversification weights. One industry won't beat the market. Without market research, John Bogle's method is hard to beat. Bogle's followers succeeded. Even if I believe in doing nothing, I don't like index investing. As the S&P 500 or VTI rises, your exposure to growth stocks grows, adjusted daily. In the last 2 years, high flyers drag down the index. My stores have low volatility. You don't need to beat the index to succeed. To avoid disasters, avoid high-risk stocks in indexes. Don't. Outperforming risk-adjusted indexes is wise. Low beta stores thrive in inflation, deflation, and recession. I have had bonds since 2000. Most purchases were made while inflation was low, but they're a solid inflation hedge. Most recession acts are performed. Prepare. In a recession, avoid risky investments. As a financial counselor, I've always thought the solution to your problem is never to get there. Suggestion 3. Don't chase individual sectors unless you're a skilled trader. Short-term outperformance doesn't justify long-term purchases. If you get it right, the cycle advances. I like quality, long-term equities. Wall Street and seeking alpha gurus emphasize different industries at different times. Favored are high-dividend industries. Paying dividends is fine. High tips shorten portfolios by boosting capital return. They may fall less during recessions. J&J and McKesson are portfolio holdings. Both are robust, uncorrelated healthcare companies. Pre-recession, I bought them. I own Travelers, Markel, and Raytheon, recession-proof industries. Lockheed Martin Corp may be included if prices fall. Insurance and aerospace/defense are recession-proof. That is not why I bought them. Recessions are part of a diversified portfolio, so I didn't forecast them. Suggestion 4. Take advantage of opportunities in fixed income. In a recession, bonds, stocks, and then commodities rally. In an expansion, bonds, stocks, and commodities fall. Third, sector timing works for talented traders but not long-term investors. Commodity stocks mimic genuine commodities for investors. Repetitive, money market funds to 30-year bonds provide fixed income. You can quicken maturities. Uncertain, rates and other indicators suggest a recession, which might lead the Fed to decrease rates. Half of my cash reserve went into a 6-month to 2-year Treasury ladder. The Treasury average rate is 3% with 50% cash. Longer Treasuries are useless. If the Fed keeps raising rates, the ladder stays flexible. If the Fed reduces rates to fight the recession, buy longer treasuries. You can also buy stocks with the money. This complicated strategy using treasuries exploits market and economic cycles. Suggestion 5. Take advantage of tax losses. I've sold losing stocks wherever possible. This is one advantage of a stock portfolio over an index. I sell red supplies or stock tranches at the end of the year. I can usually purchase it back after 31 days without paying extra. I try not to sell tax losses when everyone else does. This method turns losses into profits. A tax loss might balance capital gains in a stock you're unwilling to sell. You can offset up to $3,000 of regular income if you have no payments. Tax loss banks can be kept forever. Most portfolio investments have long-term capital gains, so I haven't had much to sell for a tax loss. I sold 2 modest positions I'd bought too early this year. I'll return them soon. Bear markets allow tax loss selling. People hate selling losers and typically take profits too quickly. This undermines the finest plan. Sell your failures, ride your wins is another market cliche. My winners have several years of experience. Taking tax losses is one of investing's few perks. Well, that's all for today's video. Tell us in the comments section how this video was. I hope that you found this one interesting. You can subscribe and watch more videos on our channel to keep up with more content. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.